Good morning, everyone, and welcome to the second panel of today, Delivering Stronger Returns and Achieving Transparency with QIS. I'm Rehane, and I'm the Business Development Director at SRP. I hope you enjoyed the first session, Moving Past the Pandemic, a Vision for 2021. If you were not able to tune in, you can stream it on demand. Before I welcome our moderator for this session, Fabien Labouret, who was until recently Managing Director in Equities and Derivatives at Barclays, I would like to remind you that you can ask questions through the chat function. So without further ado, over to you, Fabien.
Thank you very much for the introduction. For Fabien Labouret, so we are going to be speaking today about delivering stronger returns and achieving transparency through the use of QIS. And for that discussion, I'll be joined by David Stuff, by Nicola Rabner, and by Head Senior, and each of them will introduce themselves so that you know who they are. What we're going to try to do is to cover 4 different topics. One is to look at the specificity of the UK market as a first topic. The second will be specifically on strategy selection and portfolio construction. Then we'll speak about specific strategies that might be of interest to you and how to use them. And lastly, I'll ask actually my fellow members, I'll pick up their brain to see where they see the path forward, when using QIS. But without further delay, I'll ask each of them to introduce themselves in 3 minutes, and more specifically to focus on 3 things. One is to describe your respective businesses, so that in fact the attendants can understand who you are and what you do, what makes you unique, and in particular, what is it that our today's audience need to seek when they will reach out to you, which I hope they will. So they need to know why they will reach out to you. So David, would you mind starting introducing yourself and answering hopefully these 3 questions?
Yeah, Fabien, good morning. Thanks for the introduction. I say my name is David Stuff. I'm the MD of One Oak Funds, which is part of a broader One Oak group. Run by my old friends Giles and Gio, and we're all ex Barclays Capital many years ago. The One Oak Group more broadly is a business that is really focused on investor solutions. Having all left investment banking, Giles and Gio set the business up as an asset manager, and right from the get-go, the business focused really on being an investor solutions focused business, so using the asset management licenses and capabilities it has in order to produce products and services which met specific investor needs. So in terms of what's interesting, what's unique about One Oak as a business, I think the One Oak business has got a very strong asset management infrastructure, and in particular, the asset management infrastructure has been focused on hedge funds, quantitative strategies, the use of QIS, which we'll talk about later, is typically to date has been internal strategies, but now increasingly external strategies. The group has been going 10 years and has actually, in fact, been running a hedge fund replication strategy, which is coming up to its 10th anniversary, with a pretty decent track record and other strategies alongside that. So, I mean, in terms of, I suppose, where the One Oak business sits, we're just rolling out a whole series of multi-asset funds at the moment. But insofar as QIS in particular is concerned, I think one of the positions we have, which is very interesting, is we are a business that sees ourselves as intermediating or acting as a go-between between the capabilities of the investment banks and indeed the investor community. The ability to be an intelligent, thoughtful, responsible fiduciary layer, a layer that can add value in the application of QIS that may be internal, but are much more likely to be bank-derived QIS in order to deliver investor solutions is, I think, one of our particular things. And also within that, we've also got a distribution side of the business as well. So that's where we're really at. It's investor solutions with a background in quantitative strategies for the last 10 years.
Thank you, David. Passing on to Nicola.
Hey, good morning, everyone. I'm Nicholas. I'm the CEO and founder of Factor Research. And from a background perspective, started investment banking at Citigroup, then worked on the investment side for Sovereign Wealth Fund for GSE for a number of years, and then was running a hedge fund, market neutral one, for an extended period of time. And today I run Factor Research, where we provide quantitative solutions for mainly institutional investors and also financial advisors. And effectively what we do is we take data and we structure it into different customer solutions. So as an example, for example, last year, the Singapore Stock Exchange asked us, does factor investing work in Singapore? And so we calculated for them, we did a customized research report and we presented it with them. Other solutions we do is offering factors management in the sense of seeing when factors become more or less risky, or doing factor exposure analysis for institutional investors. And everything we do is data and just structure it. And most of what we do is quantitative investment strategies in terms of calculating them ourselves, like in-house, and then using that as an output. And from a firm perspective, there's two more things that are worth highlighting. So we are moving away from a service business to one direction of the fintech. Just about to launch our first fintech product, which is in the area of portfolio analytics, which will be launched in the next couple of weeks. And second point is we publish a lot of research because we're curious and we'd like to share with the investment community. So I would encourage anyone to check out our website. There's lots of research on QAS on there, and I was happy to debate that.
Thank you, Nicholas. Yes, it would be good if you can share effectively the link to your research. Would be great. Ed?
Yeah, hi, Fabian. Hi, everybody. Thank you very much for your time. My name's Ed Senior. I'm a founding partner at Fortum Capital Limited. We specialise in the liquid alternative investments and derivative space. There's effectively three silos to our business. We provide investment advice and arrangement on bespoke investments stroke solutions. Again, specialising in the liquid alternative derivative space. And we probably do in excess of £1 billion a year, targeting predominantly UK wealth, European wealth, and Middle East. Our second silo of business is that of asset management, where again, focusing on that area of investments. We have 3 funds currently, 2-3 more in the pipeline. One, effectively a structured product fund that is an equity-linked defined return investment fund. We have an absolute return risk premium fund, which is invested solely in quantitative investment style strategies. And then we have a liquid real estate fund. And then the third silo of our business is with regards to technology and analytics and building the advisory and asset management side of our business. We've built proprietary models and trading execution platforms, which we make available to our clients in the form of, as I said, trading, independent valuations, analytics, so on and so forth. As I've said, I think twice now already, our specialisation is in the liquid alt space and derivative space. We pride ourselves in being independent to the big and bad investment banks who are most likely listening in right now. And we, again, pride ourselves in providing solutions to clients, stating the very obvious, but we listen to what their needs and wants are and design product around that, rather than potentially designing product in a sort of in isolation and then trying to sell that to clients. We do it the other way around. So for those clients out there that are listening that are considering foraging into whether it be alt beta, risk premium, factor investing, derivative-based investing, looking for hedging solutions, looking for some sort of analysis around their portfolios, want some independence, want some specialisation and expertise in that field, then we can provide it.
Excellent, thank you, Ed. So I'm sure, as the audience would have captured, you 3 of you run businesses that are quite complementary. So there is an overlap between what you are doing. The overlap obviously is on solutions and portfolio construction, but we'll cover that. But you have all your specificities and edges that, in fact, I'm sure the audience captured. And I do encourage the audience definitely to reach out to you individually to follow up on these topics. Now, I said that we'll start with specificity of the UK market, because obviously we operate in the UK, and the UK market has specificities that are worth actually considering. David, when we prepared that discussion, you mentioned that there seems to quote you, there seems to be resistance in the UK domestic market for quant strategies. So the obvious question is why is that the UK market has not fully embraced QS from your standpoint? So I'd like you to walk us through your analysis of that situation, and why is that the case, and what do you think can be done or done better to tackle this market, this UK market, which you seem to indicate is quite specific. So David, if you don't mind starting, and then we'll get the other panelists to contribute.
Yeah, Fabian. Yeah, look, I think it's an interesting. I suppose to kick things off. I think there is a massive opportunity for QIS type investments in the UK space. I think the market is very big. It's still pretty diverse in terms of the range of buyers, and I think there is a huge scope. I know a few things, and also I think that, to describe the UK market as a single market is perhaps an oversimplification, but there's obviously a massive gulf between the some of the institutional investor types who I think have probably embraced QIS much more, and maybe some in the wealth management space, the discretionary management and the IFA market, where QIS has not been as widely adopted perhaps as it might be, and as I think it will be over the next few years, and I think it's interesting to think about why that is the case. I think there's been a very strong pressure from the FCA on wealth managers, investment managers, portfolio managers to simplify the investment process, to provide investment solutions to investors which are consistent. They don't want people going to Aberdeen and Exeter getting different solutions, and so the drive towards some kind of sort of managed model portfolio service has created a sort of a very beige investment world where perhaps people get a variation of a 60-40 fund one way or another. And then within that, the debate has really been about active versus passive. They have a bucket for European equities, for example, and the debate has really been: do I have an active manager of European equity, or do I have a passive manager of equity? And that's really been, I think, the numbers of the debate. A lot of portfolios have had a space for so-called alternatives. I think some of the alternatives haven't really been very alternative at all. Listed property has been used in that space. Gold, commodities, to a limited extent has been there. But the alternative bucket has probably been one of the hardest ones for people to fill. I mean, the various trade bodies have had allocations to alternatives, and I think that perhaps one of the experiences the UK have had is a sort of series of products that have looked to provide that genuinely uncorrelated return, that have, for one reason or another, sort of failed to perhaps live up to the marketing hype. I think we saw the massive growth of absolute return funds. I don't want to name names, but we all know who they are. The huge surge into hundreds of billions that went into absolute return funds, and a series of funds which were massively hyped, were widely used, and then really failed to deliver returns, and then perhaps suffered on the downside as well. There was an experience with listed hedge funds, which I think was similarly poor for a lot of UK managers. And so there has been, I think, a skepticism built up as a result of those experiences that has left the UK fund buyer market slightly jaundiced, and I think slightly sceptical. And I think that when you combine that perhaps with some of the very mixed results that we've had from sort of so-called smart beta type products, some of which have produced very, very, very poor returns, I think the buyer market has gone, whoa, all you other guys, you come out with your smart these years and being delivering.
David, I think, David, we are losing you.
Sorry.
Okay, so I think we are losing.
Can you hear me?
Yes, I think we can hear. I think we got actually the point, but we are losing you. We are losing the line with you, David. So let's carry on while you effectively turn off the camera. So again, I took that there is effectively some skepticism, but a high potential in the UK market, and that the mixed results effectively have impacted the appetite. But there is very high growth potential. So Nicolas, I would like to move on to you and wait until David can come back. And could you share with us, what are your views on the specificities of the UK market?
Sure. I can't talk about the UK market, but I think the kind of like our understanding of why QAS in the UK has been limited from an acceptance perspective actually applies globally. I think the underlying issue is transparency. So the great thing about QAS is that it's transparent. It's a quantitative investment strategy. You can often look at the prospectus or you can see how the index is constructed. The strategy you can backtest it. You can see how has it performed historically. And so effectively, a lot of the kind of like magic of active management is being taken out of the equation because you exactly know what you're getting when you invest in a QAS strategy. And that's great on a theoretical level, but often also highlights how cyclical quantitative strategies can be. So quantitative strategies are as cyclical as equity markets. So you can look at the stock market, you can see the ups and downs, but you can also look at something like a value or like carry, and they all have their cycles. And when you buy those strategies in a QS format, for example, as an index, the performance, actually what those strategies offer becomes a lot more clearer. And then if you would buy them in a combined product or, for example, in a long-only format. So, for example, David touched on smart beta. So it's quite interesting to note that there's about 800 billion in smart beta ETFs. So this is simply long-only fact investing. Now, anyone who invests in smart beta ETFs has probably come across the research of Farmer French, of AQR, of Robeco. So they all see the research that highlights the benefits of investing to fact investing. Having said that, if you look at the AUM in long-short like factor ETFs, it's 3 billion. So for whatever reason, investors love the idea of quantitative strategies, of fact investing, but often on a very theoretical level, and not if they get the real product that effectively highlights also performance that might not move in line with the market, which it shouldn't, of course. So there seems to be disconnect in a sense of what investors consume from a research perspective, what they base the investment decision process on, in the sense that they subscribe to QAS, in fact investing, risk premium, whatever you want to call it. But in terms of actually buying it and living through the experience of some of those strategies having, like multi-year drawdowns, they dislike that. And so that I think is one of the issues in the sense of investors themselves often being the largest enemy.
Yeah, and we'll come to that, Nicolas, as we move to the portfolio construction section. I think you will have to you can contribute a lot to that. Ed, if you don't mind actually concluding on the topic and tell us, from the standpoint, where do you see the potential on the UK market, and if you believe its specifics versus the others?
Yeah, I'm conscious of time, so I'll make it relatively brief and not try and repeat what everyone else has said. I think we will touch on this slightly later, but I think it's worth taking a step back and saying that over the last 10, 15 years, people's portfolios have not been diversified. You've had effectively the intervention of central banks, and effectively all the major asset classes effectively going one way. And therefore, traditional portfolios in equities, bonds, properties, some alternatives have all performed really well. And coupled with that, you've got, I think we've heard the word skepticism used around investment strategies, QIS, whatever you want to call it. Coupled with that, probably a lack of understanding, people not going out like we are now, spending time. When I say educating, I don't mean in a disingenuous sort of way. I just mean in terms of just spending time explaining to clients what these quantitative investment strategies are, the rules-based, very transparent. I think coupled with the lack of that and just the fact that portfolios have been going one way, there's not really been the need for them, if you want to call it that. And then we find ourselves in this sort of new era, maybe new dawning, where traditional portfolios may no longer work. Where investors have thought they benefited from being diversified by way of bonds, which that may no longer be the case, and therefore there will be a requirement for some alternative investments out there that provide diversification. And I think that's where the use of quantitative investment strategies and being used as true alternatives can actually come into their own in the UK market going forwards.
Thank you. That's a good segue actually to the next topic, which was on portfolio construction and strategy selection. You specifically said actually when we prepared for that discussion, so I'll stay on you, that the industry had 13 years of equity growth, happy days, and that no client had to rely on diversification for these past 13 years. And then you added that the 60-40 way of running portfolios does not work anymore. Balanced portfolio days have gone, which is a hell of a statement. So in that context, actually, and I will actually move to each of you, but Ed, if you can carry on. Again, decorrelation is not obtained anymore through bonds. So in fact, seeking diversification through the traditional 60-40 is not working anymore. So how would you use QIS as an asset class to help actually decorrelate portfolios and diversify exposure, and with strategies in particular? And I'll get actually our other panelists actually to contribute on the same topic.
Okay, I think I think it's worth just mentioning quantitative investment strategies, a bit like structured products in a way, that they cover such a sort of a vast sort of array of different types of investments that it's to some degree you need to categorize them, and in terms of providing diversification into portfolios, we effectively focus on one area of quantitative investment strategies, which are risk premia, alt beta, factor investing. They're the three main sort of descriptions you'd use for these types of investments. And in effect, the way we look at them and access them through quantitative investment strategies is effectively isolating the different types of factors that exist within all of the different asset classes, whether it be momentum, quality, curve, congestion, value, carry, long and short vol. And once you've effectively filtered through all the different types of factors, I suppose the next thing to do then is sort of statistically and fundamentally categorize each of those factors into how they have and how you would expect them to perform relative to traditional asset classes. And when it's stating the very obvious, but if you filter out all of those risk premium or alt beta that in effect have some level of positive correlation to equities, for example, if you filter those out completely, then you've gone a long way to building a portfolio that is decorrelated. And I think going back to something that David touched on earlier, I think a lot of these strategies, QA strategies, have been used by institutional clients, but I think in a lot of cases they've used quantitative investment strategies that have had some positive correlation. So the best two examples probably are short vol, where in effect you sort of short the VIX, obviously. Effectively, you're betting on the fact that you're in a low volatility environment, low risk, and a positive outlook for equities. The carry trade is effectively where you borrow in developed market and invest in sort of emerging market. That's a classic risk on trade. So those are the two types of factors that we would effectively sort of filter out of our investment process to start with, and then you then filtering in on those strategies that have, as I said, a statistical decorrelation to equities like momentum, quality, curve, congestion, so on and so forth. And then what we then go is, and in a step further, is then effectively doing a fundamental analysis. Is there some structural anomaly in the market in which those QIS strategies exist, or those factors exist, that are independent to equity markets and the macro environment itself? And we'll probably get into the specifics of particular strategies maybe a bit later on in this conversation, but if something like congestion, for example, we'll look at it and we'll sort of decompose the risk premium and the strategy into what are driving the returns. And if the driver of those returns, as I said, are uncorrelated, for example, to the commodities market, or are not driven by the movement in the commodity market or equities market, then that is effectively one way of effectively investing in strategies that are decorrelated. And then in effect, what we do is bundle those strategies together in a risk managed process, so that you've got in effect, in simplistic terms, a bunch of strategies that are statistically and fundamentally uncorrelated with traditional asset classes and are uncorrelated with one another. And that effectively gives you a portfolio that delivers you uncorrelated returns.
Thank you, Ed. And all that makes sense. And in fact, that actually connects to. So David, I think we can see your picture. I'm not sure we can hear you. Can you speak, David? Is David back? No, he's on mute.
Hang on. I can speak.
Okay.
I just
okay, good. Okay, so we can hear you. We just can see a nice picture of you, but we cannot see you moving anymore. But again, you said again when we discussed about that topic about portfolio construction, that for you what was important was not necessarily the QS offering, but the management of portfolio composition. And what you meant by that is, from what I understood, is that there is a plethoric offering of QIS. You use them specifically at One Oak, as a toolbox, cost-effective and transparent toolbox for creating products, that meet investors' needs. And what you mentioned is that in fact they need to be used in a portfolio context and not necessarily be regarded, on the merits of each versus their peers. So would you mind walking us through the portfolio construction and strategy selection from your standpoint at One Oak, and what it is that you look at when allocating and creating portfolios of QIS?
Yeah, sure. Look, I mean, I think that the, as far as we're concerned, what's been interesting is to really see, which strategies have either got real or what we refer to as latent correlation with equity. Because I think a lot of the demand that we see in the market is for products which are not only uncorrelated with equity, but are going to remain uncorrelated with equity in stressed market conditions. And I think that to find things that are genuinely uncorrelated requires, as Ed mentioned, both a detailed analysis of how strategies have actually performed in the past, but then also the application of a good layer of common sense to try and identify what it is that's causing the risk premium to exist. Is that risk premium going to be robust and resilient if market conditions become extremely stressed? I think there's a real danger that Goodhart's law applies in factors, or applies here, and that things like value and quality, which have proved in the past, or that there was an assertion that for example, quality was a driver of subsequent returns. I mean, it may well have been, but I think almost the minute that these value and quality factors get identified, they cease to be robust and reliable, because there's absolutely nothing stopping monster institutional funds tilting their portfolios to take advantage.
David, I think I think we are losing you again, David. It seems that your speech. Yeah, we are losing you again. Very sorry for that, David. Okay, so David, while you reconnect, I'd like to ask actually a question to Nicolas, because his approach again to portfolio construction is quite unique. You're operating, you said, Nicolas, like a fintech, and you said that in some aspects are very, very data driven. So can you just explain to the audience how actually you use data in your allocation process and your selection process?
So if I look back from a firm perspective, 10 years ago, we used to hire Master of Finance students who could code in VBA and MATLAB. And today it's all about computer scientists and people who effectively can come more from a tech perspective and can pick up the finance knowledge after. So as mentioned, everything we do is taking data and structuring it. And a large part of that is actually cleaning data. And it doesn't matter if you talk about normal data like Python fundamentals, if you talk about alternative data, if you talk about ESG or so, but everything requires, like almost like a technology company, you need your servers, your tech stack. Where the data comes in, you process it, and you clean it, which is about 80% of the work, and only 20% of the work is actually structuring it. So, for example, calculating the value factor. And of course, there's a lot of intricacies where you can do that, and you can also buy that off the rack, right? There's enough providers who sell the data. But for us, it's a major competitive advantage in the sense of, from a firm perspective, being able to do everything in-house. This is not only that it allows us to structure portfolios or design strategies to customer requirements, but also to learn about them. Because as soon as you get into the nitty-gritty of, for example, designing risk premia in fixed income, which is quite complex, you learn about them and you pick up things. And that, of course, is also knowledge that you can then put into products and portfolio construction. So that's what I mentioned with regards to becoming more and more authentic over time, simply because everything is data from our perspective. We just have to put it into different buckets. Depending on what the client wants, if it's a report, if it wants a strategy, if it wants to launch an ETF that has an index beneath it, but everything's data.
Thank you, Nicolas. Thank you, Nicolas. And I said David is back. So since time is running, and in fact, you in your discussion, you mentioned actually strategies, actually very specifically. I think we covered the sort of topic I had in mind. But I'd like to come back to active portfolio composition. So David, coming back to you, I'd like to understand, when you create portfolios, I understand the selection process, and you did walk us through that, but I'd like to understand, since you're acting as an asset manager, yourself in particular, as well as Ed, are you actively managing strategies, your allocation, or when you create a portfolio, they're relatively static? So can you just explain that to us, whether it's active, static, how frequently you reallocate across strategies?
Oh, look, I tell you what, I think that it's the most important layer here, that we are definitely active in the portfolio construction and portfolio management process. I think it's a vital layer that needs to be applied. So we have an active process to try and identify strategies. We put strategies into a number of different buckets, and we are actively looking to see which strategies should go in which buckets, and then we combine buckets in order to create portfolios. And both in the strategy selection and the grouping, we use different techniques and different processes to weight strategies. For example, if we're using strategies which are defensive in nature, we certainly don't want to be using any sort of risk parity type, because if you have a strategy where you have an asymmetry and volatility, or a non-linear volatility profile, we don't want to be using a risk parity type process to allocate to those strategies. Where you've got strategies, some of the congestion type trades or carry trades, where there is a more linear payoff than risk parity and so on, can be an appropriate way of looking at that sort of thing. So yes, we're very active in terms of strategy selection and then combination of the buckets that we have into the overall portfolio.
Understood. Thank you. And that makes sense. Again, operating as an asset manager obviously is an edge that you need to put in motion. Ed, from your standpoint as well, how actively actually you do reallocate strategies, and what's the frequency of this reallocation or permutations?
Yeah, so we're active. Again, similar story really to what David just talked through, in that there's a strategy selection process which I alluded to earlier on. And then effectively there's a and I again touches a little bit on what Nicolas said, I think, earlier, in that these strategies tend to perform for prolonged periods of time and then stop performing. Some people call it autocorrelated, but long story short, there's a sort of statistical approach and a common sense overlay. The statistical approach is that these things do tend to perform for prolonged periods of time, as I said. So we apply a momentum type approach to investment in the strategies, but then they tend to stop performing, and when they stop performing, we deselect. But then also overlaying that is, again, I already heard this terminology, common sense approach, in that these strategies tend to work differently in different macro environments. And again, we don't select strategies based upon a macro investment view. If we had a macro investment view, I think we'd be using sort of more traditional assets that probably have more potency than risk premium, that are probably the least potent sort of strategy that you want to use to make a macro call. But what we do recognize is that these strategies do perform differently in different macro environments. Congestion is a great example, which tends to perform better in lower volatile environments. So what we will tend to do is, again, you'll have heard this terminology before, apply more of a, I'd call it an oil tanker. I wouldn't call it a speedboat where we're kind of, deselecting and selecting on a frequent basis, but more of an oil tanker approach in that we'll steer the sort of portfolio through different macro environments, and as I said, be sort of recognize certainly what environment we're in and also what the environment's looking like going forwards. And as I said, we may touch on it later, but congestion is a great example that up until Q1 last year was a strategy that performed well. You were able to harvest the risk premium that is associated with congestion in that space in a sort of a relatively linear way. But then as soon as you saw volatility enter that asset class, the commodity space, even though that strategy itself is not ultimately correlated to a high degree with that asset class, it does tend to suffer in a more volatile environment. And therefore, what you may tend to find is that risk premium that you're trying to harvest, so to speak, gets overwhelmed by the asset price volatility. And in that environment, you tend to find that we'd basically deselected or decreased our exposure to the commodity congestion strategy into other strategies that perhaps like a more volatile environment, like, for example, long rates vol, which is a strategy that we've increased our exposure to over the last 1 or 2 months as we saw volatility enter the bond space, as was the case to a great degree last week, of course.
That's interesting. Thank you, Ed. And we had actually at Barclays, we had developed also a macro factor framework to help actually our clients precisely identify, which risk premium would work in certain macro factor environment. But again, it was on the investors. It was for the investor to decide which macro he was actually anticipating, for us then to make the analysis and identify what risk premium was actually suitable for that macro environment. Again, working with an asset management license gives you obviously the freedom for making these calls. So Nicholas, moving back to you, because again you said that, again I'm coming back to the data-driven approach and the fact that you publish research. Are you because you're a research-led firm, are you publishing indicators, research-based indicators for strategy selection? Is it something that you are publishing, or indicators, macro factors? I would call it also attractiveness scores for risk premium. Is it something that you are publishing?
Yes, so we publish on everything. We look at hedge funds, private equity, venture capital, risk premium, whatever rouse our curiosity. With regards to QIS or risk premium strategies, I think there's a clear indication that macro variables have an impact. So you can look, for example, at value, right? So picking cheap stocks. And I think often things are overcomplicated. But when you think about picking cheap stocks, often, you can simply explain why that works or why it doesn't work by macro variables. And specifically think about when someone, like a normal person, would buy risky, cheap stocks, because a company that is trading at a low valuation, a General Electric, for example, you only pick that up when you feel comfortable about the macro environment. You don't invest in GE when you have a large economic crisis ahead, because they're going to not do good from an earnings perspective, company perspective. In that case, you would probably more load up on the quality factor and invest in things like a Novartis, a Roche, more like a pharmaceutical space. So effectively, macro variables have a very large impact on the returns of risk premium strategies. However, the issue is, of course, measuring that, and especially on an out-of-sample basis. So, for example, let's talk about value and size and quality and low volatility. So you could clearly make a framework that it's more sensible to invest in a factor like a value or like a size when the macro environment is benign. Effectively, when there's no concerns, investors feel relative okay about taking up more risk, versus the inverse ones, of course, in terms of when you're heading into a crisis, then you want to play more defensive and invest into quality or low volatility stocks, or any other asset class. Having said that, timing that, of course, is difficult, right? Because macro variables get reported with a lag, they're often revised, right? So although you can find relationships, it's often based on few data points, which is not very scientific, and then often a difficult, more on a going forward basis, because how do you predict them? So can you point out relationships that drive risk premium strategies? They can. We also publish on that. So that's what we think about factor risk management. When do factors become more risky or less risky? But it's more the problem of applying it in a very robust fashion out of sample. And that's the challenge about that.
Understood. Thank you. Thank you, Nicholas. Obviously very relevant to the discussion and very useful, again, for asset managers as well as investors. Given the time limit we have, because I'd like to leave actually a few minutes for open question, we'll move to the last topic we had. We covered actually specific investment strategies. You mentioned short vol, momentum, congestion, value, quality. So I think we covered, most of the strategies and without going into detail specifically of each of them. But again, that can be taken offline. I'd like to move on to what do you see is the way forward? Because again, all these strategies are looking backward, they're back tested, and as you mentioned, each of you mentioned, sometimes it's a nice and lean back testing, but it's a poor forward performance. So where do you see the market going? Where do you see opportunities forming? What is it that you're pushing forward? Because each of you operate in an investor solution or client-driven or solution, product pushing. So I'd like to understand what is it that you are pushing forward? Are these investment teams? Are these structured funds, portfolio construction, or specific products? What is it that you are pushing forward? And where do you see an avenue into 2021 using QIS and thematic strategies in your respective products? I'll start with David, because David, you have been cut a few times. So I'd like to make sure that you have enough time to answer.
I've moved now, Fabian, so I'm now sitting on my router, so hopefully it's a better connection. I think it's interesting because we all are in this market in different ways. I mean, I wearing my multi-asset hat, you've got to think that factors are a much better way of dividing your exposure on a multi-asset layer than geographies. It seems to me sort of rather bizarre that we all think about European exposure and US exposure and Asian exposure and so on, where those are sort of rather random collections of companies. And as Nicholas in the sort of firm he's in is almost having to break down those indices into what factors they are. And, people are picking European equities because they are long or short of particular factors. It would seem to be much better to have global factor exposure for multi-asset rather than the sort of the historic geographic split we've got. The two other bits that I'll quickly mention. Firstly, genuinely uncorrelated returns as a result of structural, tax, regulation, or whatever. I think it's a really interesting space, and I think we'll get a lot of money there. The other bit I come back to is both Ed and I have been involved in funds and structured products. And interestingly, I think negative convexity. It's a very difficult shape for people to hold in a portfolio, to have something which has positive correlation becomes more positive when markets fall apart. But in actual fact, I think that negative convexity, as more work goes on in it, there's a real positive return story to be had from investment in that sort of profile. And it may well be if we see equity market returns generally being scaled down, that replacing equity with negative convexity would be an increasingly attractive thing. So that's where I would go. Multi-asset, use factors in multi-asset rather than geographics, genuinely uncorrelated returns, and maybe look again at negative convexity. Okay, so multi-asset and negative convexity. We'll come back to that, just to be more specific on that. Ed, on your side, actually, what is it that you see going forward, or where are you positioning your clients?
I think just to echo really what David mentioned and repeat slightly of what we've talked about at the outset, in that it's our belief there's going to be an increasing need and demand for investments that provide for truly uncorrelated returns to traditional asset classes. I keep banging that drum, but I don't think that should be underestimated. And I think, therefore, providing solutions or investments or funds that effectively are as transparent, simple, have simple and transparent, well thought out processes. As Nicholas said, I think one of the things that QIS may have suffered from in the past is that the perceived complexity. So if you have an investment process or thesis that's relatively, as I said, simplistic, i.e., firstly, categorize the QIS into their different categories, stating the obvious. Disseminate those strategies into the factors, as David alluded to, and then effectively identifying those factors that have statistically and as I said, structurally, on a forward-looking basis, common sense overlay, I think is what we say, and David's used that terminology as well, on a forward-looking basis will provide decorrelated returns, and putting them together in a portfolio that, as I said, has this holistic macro environment overlay to provide something that is truly decorrelated to traditional asset classes is where I think we see the potential demand and the appetite on a forward-looking basis.
And can you give us an example of uncorrelated, strategy that you have in mind? So you mentioned congestion when we spoke, FX, commodities, but are there other strategies that you would actually push forward?
Yeah, I mean, there's a number. As I said, some of them work better in different market environments. We've seen the classic quality factor kind of working over the last few years. We've seen value not work for a prolonged period of time. What is it, 10, 15 years? There's been a few false dawns. Again, you can isolate those factors. And whilst they do obviously have different performance regimes, so to speak, depending on what macro environment you're in, it's possible to isolate that factor and stick them into your portfolio. And again, create a portfolio that is in simple terms, the strategies are decorrelated to one another. And also decorrelate to the market as well. Congestion is a great example. Again, I don't know how people are familiar very quickly as to what congestion is, but think of an equity index that rebalances once a quarter, and there's stocks that go in and stocks that go out, and there's buying pressure and selling pressure. That buying pressure and selling pressure, Tesla was a great example recently that got added to the S&P. There was massive buying pressure on that stock going into that index. That's the concept of the congestion risk premium, and hopefully for the audience they can conceptualize that rebalancing sort of feature is completely uncorrelated to markets. It doesn't matter whether the equity market is going up, down, or sideways. That congestion kind of risk premium is the types of strategies that we see as being statistically, and as I said, on a common sense overlay point of view, being uncorrelated to traditional assets and a sort of macro environment. And it's those kind of strategies. And I mentioned earlier on, we've seen that congestion sort of dissipate a little bit because of the volatility that's come into the commodities market, and that's been replaced in our portfolios or sort of de-weighted, and we've seen increased weight into things like rates long vol. Again, we're getting a little bit geeky and sort of down and deep and dirty here, but the rates long vol strategy is a classic strategy where it's contrary to traditional asset classes, where on a longer term basis vol tends to be upward sloping. The rates vol is downward sloping, and it's a classic trade where you can effectively harvest the roll up of the vol whilst also taking advantage of an increased volatility environment like we saw last week. So not only does it give you the benefits of decorrelation, but actually it can provide you with defensive characteristics when you have a sort of an asset sell-off like we saw last week in the bond market. Those strategies were all up 1-2% last week on the back of, as I said, increased volatility in the rates vol environment. And that's two contrasting examples of strategies that are completely decorrelated, but actually one likes a high vol environment and one likes a low vol environment. And it's our job to effectively navigate between those environments to make sure that our portfolio is positioned to take advantage of that, or at least mitigate the risks associated with being in the wrong ones.
Thank you, Ed, and thank you for being specific on strategies. Nicolas, from your standpoint, where do you see 2021 going, and what are the opportunities that you're putting forward for your clients?
We don't have any short-term views because we're very academically focused, and so go back 100 years to look if strategies are good or not good, right? So don't have any ideas in terms of what will be good on a one-year basis because it's meaningless from our perspective. But I could just echo David and Ed that most investors are massively underweight long vol. So if you look at a classic institutional investor, pension fund, he's going to have his private equity allocation, which has been ramping up. He's been increasing his allocation to venture capital. He might have probably decreased equities, and he kind of doesn't know what to do with fixed income. That's about 99% of most institutional investors out there. And everything in that portfolio is short vol. It doesn't matter if you can't measure it. For example, fixed income, you could argue is not short vol, but you're still betting on companies or governments to pay back debt sooner or later. With equities and private equity, venture capital is of course much clearer, right? You're effectively betting that they will continue to hum along and do good, supported by governments and central banks and whatnot. But if you take a bit more medium to long-term perspective, that this might change because you have high valuations, you have negative demographics, you have huge amounts of leverage in society, that your portfolio, I think about pensioners, for example, shouldn't all be short vol. It's worked fantastic. I think we're all in a honeymoon period of having Nick lived through this period of great equity returns, great fixed income returns. That's over. And I think it's going to take another few years for investors to realize that expect and feel it, that expected returns are just very low. And then, of course, you can use uncorrelated QS strategies to kind of like supplement that, or specifically go in the directions that David and Ed mentioned that I can just echo, go long vol. Is it easy? No. Is it painful? Very much so. But I don't think investors have a choice.
But precisely, Nicolas, because I would agree with that. The thing is, you are rarely rewarded from a management standpoint for being right when the market goes wrong. So being long vol is a costly position to run. So how can you help actually clients with indicators actually adjust their long vol position? Because you have seen a lot of QS strategies with signal in them, and the signals have been designed actually to deal with past events. Rarely they work in the future. And if you draw the parallel with a car insurance, you pay your car insurance. You are never pleased to pay your car insurance. And it doesn't make you willing to crash your car because you're insured. So it's a bleed to a portfolio. Being long vol effectively becomes a bleed to a portfolio. So how do you make it not too painful for clients to carry on that position? Because being long vol, I do agree, is a good strategy to hedge your portfolio. But what are the indicators that you can bring to clients to make sure that they don't bleed and they don't have to cut the position at the worst time?
My 2 cents are, for most investors, they should look at this from a long-term perspective, strategic perspective, accept the bleed, try to keep it minimal. But once in a while, if you look at how painful it is to hold long vol, look at an equity market like Japan that had 20 years of no returns. So that bleed does not only need to happen in long vol strategies, you can have that also in equities or fixed income markets in the 70s, right? So just use data, history, right, to just remember yourself or recall that even if your strategies have worked quite nicely over the last few years, might not going forward, and just accept it. Now, having said that, there are, of course, frameworks you can use, right, in terms of being active about structuring a long vol position. But what you have to be very careful is that you avoid to introduce, again, too much short vol in your long vol allocation. So I think this is almost philosophical, right? Because you can say, fine, look, I'm going to have a 90% equity and 10% long vol portfolio, or I have a 50% equity portfolio, and then 50% short vol, long vol. But it's about measuring the exposure. I would argue for most investors, try to keep it as simple as possible. Be aware of what you're buying into, understand why you have it, document it. In doubt, read your documentation again, but just live with it. And like investing is not easy, and it's not going to be easier.
No, I agree. It's always a tough discussion. People tend to put this position in place after the fact and cut them before actually they need again, because they just cannot sustain the bleeding. Yes, it's insurance. It's like an insurance. It's exactly like a car insurance.
You pay.
Exactly. David and Ed, do you have comments on that? And I'll have another question for you. But do you have comments on long vol strategies? Because again, tail risk hedging is always on the mind of everyone. It has been a big theme, obviously, in March, April last year. Do you have any comment on long vol strategies and the way to structure them, David?
Well, I mean, clearly, long vol, protection, defensive strategies have been the thing for the last year. Everyone's been talking about defensive strategies all the time. To my mind, it is going to bleed. So the only point of having defensive strategy is if that then allows you to increase your equity weighting significantly. I think defensive works if you go from 60-40 to maybe go, 75 equity with a defensive hedge, and you crush your fixed income allocation, then I think it's, defensive works if essentially the bleed that you're going to spend allows you to so increase your equity exposure within the same risk budget you've got that net you're better off. And I think that some of the work that we've seen and we like is all about trying to identify essentially how much more equity you can get for each dollar you allocate to the defensive strategy. And I think that's a really interesting bit. I mean, there's obviously been a flurry of new, can I buy a put without paying the premium? Whether or not these strategies seem very attractive and very appealing at the moment, we wait to see how good they are in the long term. But I think that's right. You've got to use defensive in order to increase equity if you're going to go down that route.
That makes sense. Thank you, Ed. So that we can leave just a few minutes for questions. Do you have any comment to add in 1 minute?
I think we just go back to the same statement, really. That if people invest in equities, right, because over the long term, that's where you get your investment returns. And I think what we're talking about here is effectively taking the edge off those periods when you get significant drawdowns, and again trying to time the market. I think again has been proven for decades and years and centuries that it's not possible. So for us, it's about having a balanced portfolio. It's about having effectively your growth factor, your equity growth factor being your predominant deliverer of returns over this medium to long term, and then just effectively having some diversified investments. I go back to a holding in investments that are completely uncorrelated. That for us is the way of generating a diversified portfolio, as opposed to trying to time the market with long vol strategies, which again you can try and cheapen them. As David said, you can set synthetic puts, best of puts, timer puts, all the stuff that investments banks try and flog us. But at the end of the day, most of it comes down to some element of timing, and that's difficult. So we look at it over a longer term basis. Have your equity growth factor in there, but have some diversification in portfolio at the same time. And that's where these QIS and portfolios of QIS, I think, will come into their own.
Thank you, Ed. Operator, are there any questions that came through by any chance? Because we have 3 minutes left. I'd like to know if there are questions from the audience. No, so I don't see any questions. So I had actually one question I was willing to ask, actually, and maybe that will be we can conclude on this one. Have you been, since you are users of, each of you are users obviously of QIS, have you designed your own strategies, or have you ever tried actually to execute your own strategies? Or let's put it another way, have you been designing or customizing strategies? Is it something that you are doing or that you're offering clients, the possibility of customizing strategies for specific needs?
Sure, every day.
Oh, that's good. So who said every day? Nicolas?
I did, yeah, of course. That's what we do all day long, right? Designing strategies, either from a research perspective or a client has something he wants to see. For example, I don't know, does factor investing work in pharmaceuticals? So you might have a healthcare PM and is interested, does it work? And sure.
But, you get them but then you execute them. You execute the strategy?
So on the personal basis, I've done it, of course, in my hedge fund days. But nowadays we live execution because it's not interesting to us. Live execution with the clients.
I see. And what about you, Ed? You said you agree to that as well, Ed. So have you been designing your strategies or implementing signals in strategies, customizing them?
Yeah, we do both. Let's be honest. We're a boutique firm, and you look at the investment bank universe, and each investment bank has a plethora of traders, quants, strategists, research analysts, so on and so forth around the globe. They see the flow, they see the execution. They have the execution platform. So we're quite pragmatic. We're happy to listen to the investment banks and their ideas, and we may implement some of their ideas. We may work with them on tailoring ideas. We saw something in the rates long vol strategy 6 months ago that we liked, but we made a slight tweak by working with the investment bank explicitly to tweak that strategy to take a kind of a specific view, so to speak, or to at least mitigate some market risk that we weren't comfortable with. But then, as I said, we're pragmatic. We will execute the transactions in the most cost-efficient manner, which is to the benefit of investors. And invariably, that means we'll do it with the investment banks because we're accessing their global trading and execution platforms, which gives the best cost-efficient, as I said, result for our clients.
I see. Thank you. And yourself, David, just to conclude, so since you said you do investor solutions, that's how you define yourself. Are you executing specific strategies for your clients?
Well, OneOak run a number of self-created strategies, but I mean, as far as the new stuff we're looking at, it's very much a case of trying to use the bank strategies. And I suppose I'm very wary of anything that looks over-optimized, because the only thing you can guarantee with something that has been over-optimized is the decay into the live period is going to be very significant. So we anything that looks over-optimized, too many signals, too complicated, we would step away from. So we're inclined to try and use the simplest versions of things that we can.
And that does make sense. From experience, it makes sense actually to use simple strategies. Signals are usually designed to deal with to deliver a very linear backtest, but they usually have a tendency to create flat, forward-looking performance. I think we're up for the hour. If there are no question, I think we might have to conclude. Any question, operator?
Thank you. I think we can wrap up. I think we're also out of time. So we had a few questions, but I believe we're now out of time. So I hope everybody. Yes.
So then if there were questions, actually, if you can route the question to the speakers and they can take them offline, that would be actually very good.
Yes, that's what I wanted to say to Fabian.
Oh, thank you.
Okay, great. Thank you for another great panel, everyone. And Fabian, thank you for moderating, and the panelists obviously for making this happen as well. So as Fabian mentioned, should there be any follow-up questions, you can actually go and ask them directly to the panelists on the chat function on the platform. We will have now a virtual networking break, so use this opportunity to visit the exhibitors, which can be found on the homepage under exhibitors, and also visit attendee profiles, book meetings, chat, and have one-to-one video chats as well. And we're looking forward to welcome you back at 1 p.m. GMT with our fireside chat, Navigating Uncertainty Without Regulation in Russia. And happy networking, everyone.
Thank you.